The information and opinions expressed in this video are of a general nature and are not intended to be investment advice, research, or recommendations. Please consult your investment professional for your own circumstances. The information in this video reflects the opinions of Arca Labs and the video's participants on the date of production and are subject to change at any time without notice due to various factors. Arca Labs is separate and unaffiliated from any third parties participating in the video presentation, and Arca Labs is not responsible for any third parties' products, services, or policies. Welcome to Tokenization Talks, powered by Arca Labs. I'm Annelise Osborne. At Arca Labs, we're focused on innovating responsibly. We are excited to bring you institutional thought leaders in the digital asset space. Our guest today is Keith Coyne, who is head of strategy and product for Cowen Digital. Cowen Digital offers full-service trade execution and custody solutions and provides institutional clients with secure and compliant access to the digital asset ecosystem. Keith, thank you so much for joining today.
Thank you so much for having me. Happy to be here.
That's great. So, Keith, I know we were supposed to touch base a few weeks back, and there was a bit of a market disruption. But I think the market disruption really highlights the importance of traditional finance structures and counterbalances from a risk perspective in our new ecosystem. So I thought kind of what we could talk about today is really the opportunities and challenges for traditional finance and digital assets, and especially as we're coming into the new year. So I would love to, why don't you introduce yourself a bit and then we'll kind of dive in.
Sure, happy to do that. So I've been at Cowen Digital for approximately 2 years now. I was one of the first employees in Cowen Digital, which is the digital asset division of Cowen proper. So Cowen, has been around for over 100 years in traditional finance, everything from investment banking to research to trading and prime brokerage type services or prime brokerage services. And so, a couple of years ago, they started looking at the digital asset ecosystem, particularly as it relates to things like Bitcoin options. I think there was a lot of interest and demand to start trading some of those markets. And I think it started really how can we get clients access to ETFs or futures or Bitcoin options. And when they went down that rabbit hole, they really realized that there wasn't a lot of institutional infrastructure, and there was certainly a lot of client demand. And I think that was the genesis or the catalyst for starting to think about, is this something we can add value to our customers in, and is it within our wheelhouse in terms of the strengths that have made us what we are today. And so, one of the things and one of the reasons I was really attracted to Cowen is there's very much an entrepreneurial spirit here. They are a boutique investment bank in terms of they're not as big or as broad as some of the larger players. And there's a very much an entrepreneurial spirit here. So, when there's new opportunities or new markets, they come with a how would we do it? What are the risks? And how do we do it with the right framework and from a regulatory and control perspective, as opposed to that sounds really risky. Not sure the revenue justifies it, and let's move on to the next thing. Certainly that's part of the equation, but absolutely, like there's an openness and a willingness, and that goes across all of the functional areas that support the business. So it's been amazing to work with our compliance team, our legal team, our tax team, because they all sort of come with this, all right, how we're going to do this. So how are we going to do it in the right way, and how do we figure it out? And so that's been really helpful for us to get into the space. And I think, from there it was, okay, so what role are we going to play? And one of the first major decisions we made was, we took a look at digital asset custody as a foundation for any markets business, and we realized that it's very nuanced. It's relatively new in the space, and it wasn't necessarily our expertise. And so with that, we decided to look for someone to partner with on the custody side, which ultimately wound up being PolySign, who's the parent of Standard Custody. So we led their Series B a little over a year ago. We also were involved in their Series C, which was the purpose of the Series C was to acquire MG Stover, But the idea being is, we know markets, we know trading, research, banking, et cetera. Custody is not our forte, particularly as it relates to digital assets. Let's partner with a known similar entity, which is Standard Custody has their trust charter from NYDFS. They are institutional focused. They have unique cold wallet solutions that we think is best in class. And so it was really a strong partnership that where we align not only from a product perspective, but from a cultural perspective.
Great. So you're coming at it from an institution putting together rails for other institutions to play or enter the digital asset crypto space.
Yeah, that's the idea. So, we've seen that happen in practice. So we looked at, what infrastructure do clients need in order to get comfortable starting to access the space. And so things like an OMS EMS system, sure, we have one that we can put on your desktop, but our first priority was actually setting it up in a way that we can integrate with your traditional OMS EMS system. And so we're live with Escastle as one venue where clients who are trading equities on Escastle can actually, switch over to digital assets and trade, route orders to us through that OEMS. So, and we're looking to connect to multiple others that are still in the process of setting up their product, but that's sort of been more of our target was to, not necessarily compete for space on the screen with our traditional clients. It's more how do we integrate digital assets into their existing infrastructure and just remove some of the friction that it would take to get involved in the space.
Great. So you're adding an alternative asset class to within their current book.
That's right. That's right.
So kind of given the current market, what do you see as the biggest trends in the crypto/digital asset world that have been impacted with FTX?
Directional trading. So I mean, I think the biggest trends clearly holding assets on exchange is going to be something that everyone is taking another close look at. Certainly, we've seen an exodus from those who are holding assets on exchange, and the question becomes, where do they go? Do they go to a self-custody model or do they go to a qualified custodian whose main business is being a custodian, not, vertically integrated exchange, market maker, and custodian with no, audits or boards of governance. So I think so the quickest thing is people thinking about counterparty risk as it relates to some of the exchanges as well as their trading counterparties. That's certainly important. And I think for a lot, there's been a trade-off of level of security within a custodian versus how quickly and easily you can transact through a segregated custodian. And that's been something the market as a whole has been, sort of struggling with for the last few years. And I think we're really starting to see some of the current solutions coming to market that are, that you don't have to sacrifice that security in order to be able to transact very quickly.
So you expect that market will develop because you just said coming to market, right? So some of these custodian offers, do you think there'll be kind of newer players, or do you think they'll go with the established, obviously larger established institutions are coming up with custody solutions as well? And where do you recommend outside of the fact you have an interest in PolySign?
Sure. And from our perspective, from a trading perspective, we're agnostic to where our clients are. But if they're looking at custodians, we certainly would recommend and refer them to Standard Custody as, one of the custodians that we believe has an excellent offering and we have some integration. But certainly clients look at other custodians as well. But I think it's probably a combination of both. But I think it certainly is going to be less of a I think it's more going to be more of a standalone custodian that's going to win going forward. So whether it's, cold storage or warm storage or some combination of the two, I also think seeing things like traditional banks with very large balance sheets and credit ratings incorporating some of the custodial software and technology, but putting it underneath their brand and their reputation, like that's going to get additional customers comfortable as well. So your large institutions are used to, custodying assets with someone like Boney. So Boney using a Fireblock solution is certainly going to help some investors get over that hump and get comfortable. Now, I think, the more they look at the technology, the more they'll see that there's other competing offerings that they could still go with. But I think something like that is certainly going to give credibility and trust back into the market.
So where do you see some of the key growth opportunities for traditional finance coming in 2023?
That's a good question.
Sorry, traditional finance and digital assets.
Right, coming into digital assets. So I think there's been a number. We've talked to countless numbers of large asset managers, traditional clients, and to be honest, like that's sort of what we think is our edge, is that we have 3,000 paper traditional finance clients at Cowen who trade with us daily, so or trade with us frequently. So, certainly we are in contact with most of them who are in various stages of investigating this space. But a lot of them are pretty close in building out infrastructure and really evaluating, different service providers. And so I think that's still moving forward. I think, in the short term, there's probably less, I think they have a little bit more time than they thought before the market bottoms out and they miss the opportunity. I think they'll probably wait to see a little bit of a rebound before they decide that, all right, we've put a bottom in. But they're certainly putting the infrastructure in place. And I think what you're seeing now is you've had a lot of talent go from traditional finance to blockchain and Web3 and digital assets. A lot of companies might be struggling over the next 6 to 12 months given what's happening. So but those people are getting great experience and they're really understanding the tech and they're understanding the nuances of the space. And so I think you could see some of those players go back to some of these more traditional, asset managers, funds, banks, et cetera, and bring that experience with them, which hopefully then has the effect of accelerating their overall adoption.
Okay, that makes sense. So we haven't really talked about DeFi much in my institutional tokenization role. So it'd be interesting to give a kind of a brief. Can you just tell us generally what DeFi is, and then really how traditional finance can take advantage of that, or kind of as the ecosystem grows, how you see maybe DeFi and TradFi coming together?
Sure, absolutely. And DeFi is it's a big topic, and I'll do my best to talk about it at somewhat of a 10,000-foot level. But generally speaking, it is more of peer-to-peer transactions as opposed to having financial intermediaries. And so many of these DeFi protocols are set up in a way such that you and I don't necessarily need to know each other in order to transact. If I put a buy order onto a protocol and you're willing to sell, we don't necessarily need to know each other. We just fund through the protocol and the transaction happens. And the idea being, it opens up some of those services to a lot of the world who necessarily doesn't have banking services or can't get an account at a Goldman Sachs as an example. But so I think, and it's much more than that, but that's just sort of one use case. And so the idea being that you have protocols that are not centralized. There's no Google, there's no Microsoft sitting in between, or there's no bank sitting in between, peer-to-peer transactions. And so the idea being they should be much less expensive if you're not paying a toll taker in the middle as an intermediary. And so I think there's a lot of validity to that sort of model. Certainly regulators and to some extent some of the participants are concerned about the lack of KYC AML in that space. And so the way I like to think about it is I certainly think it's the future of financial services for the most part, especially for retail. But I think, it's not quite ready for prime time. It's not quite ready for institutionalization. And I think things like, tokenized identity, which will come over time, but are not quite there yet, will certainly help that. But there's a lot of really cool and interesting things that are happening in that space, and the transaction costs are much lower than in traditional finance. And so my view personally is, it's really hard to go from 0 to 60 without a couple of intermediate steps. And so there are really cool features we should be thinking about integrating into some of the things we do in traditional finance that certainly would pass through lower cost structures to the end users. But you also need to bring in things like KYC AML that we have in traditional finance to make sure that that nothing, it's not being used for terrorist financing, and there aren't transactions with the OFAC countries. And so I think we need to sort of come to the middle to really get to a usable product. And then eventually from there, you'll have different, sort of paths that it can take, and some will be more regulated than others. But right now, you can't go from completely regulated to completely unregulated. There needs to be sort of an intermediate step.
And there are intermediate steps that are being worked on, and there are some platforms that I understand that we can work with. So what about this one? From DeFi, there's a lot of lending contracts out there. There's a lot of in the world. There's a lot of people lending stablecoin, for example. We're in a world of increased interest rates out here in the traditional finance world, and yet the contracts for some of these DeFi stablecoin loans is still very low. So can you talk about how you see this difference of those two interest rates? Right? If I were to get, tips right now are very high because inflation is so high.
Right.
But you can still lend it a couple percent. Isn't that right in DeFi world?
You can. But the question is to me, like, has that been stress test appropriately? If there's the things that concern me most about DeFi are not just the KYC AML, but also the technology to interact with it. And so you need to be using a self-custodied wallet, which introduces a number of security risks. You're using smart contracts, which many of the larger protocols have been audited and are very credible. But there's technology risks, there's infosec risks. So there's things like that that I think are certainly functioning properly today, but we do hear about different hacks that are taking place. And so I don't think everyone's comfortable yet with the idea of putting significant amount of assets into a space that there is no sort of central intermediary that says, if something were to go wrong, our reputation is on the line here. We're a public company. Regulators will come after us. We'll lose our entire business. There have also been examples of protocols that have spun up and sort of disappeared very quickly after doing a fundraise. And so, and not to say that that's a very small portion of the space, but again, it's about putting the right framework in place so that people can get comfortable with the idea of putting their assets into those ecosystems.
So I agree. I totally get what you're saying. So it's almost, you're talking about different iterations, right? So we're learning from every iteration that's done. So it's almost like the crypto market is a proof of concept for where institutional finance will go, right? So we're working out a lot of the kinks in the meantime. So what about risk? So from a risk perspective, how do we look at cryptos and digital assets? And the reason we're talking about cryptos more is because there's more of them, right? So digital assets, which are securities, technically, like the way that we're trying to create securities in the digital world. But how do you look at de-risking yourself, or what are the risks as an institution that I want to come into? What should I know?
Yep, obviously top of mind currently. So I think everybody pretty much understands, or for the most part understands, the volatility risk, right? Particularly as it relates to the large cap coins. I do think they're certainly by some of the smartest people in the space, there was a different sort of understanding of the risk of tokens that are tied to that are centralized or tied to specific companies. And I think that's what we saw with the FTT token, where it was ascribed a value on an exchange, but that didn't necessarily mean just because, small clips trade on that exchange at that price. If you had to liquidate a large amount, these are still relatively illiquid markets. And so I don't think there's an appreciation for some of these smaller tokens, how illiquid they truly are relative to the size of VCs or foundations that are holding, the total assets. So I think that's something where the industry could do a better job of sort of discussing that, talking about it. What's the actual float of the coin versus the market cap? And so I think those are two very different things. Certainly, counterparty risk still remains a problem. And even if you're trading OTC, somebody has to settle first. There's no centralized clearing, there's no prime brokers. So counterparty risk remains an issue that has yet to be solved. And I think, until we get some of those larger institutions involved in the space, it's hard for sell side service providers to justify the expense of getting into this space. And so, this is where, Cowen has been on the forefront of saying, we're confident it's coming. We think this is the future of financial services. Let's dig in now, and build out while others are sort of sitting on the sidelines and waiting.
Got it. Great. I have other questions, but I realize we're running short on time. But what I would ask is kind of how do you see next year, 2023, right? Where do you see kind of the growth, I guess, opportunity and challenges in 2023? Where do you see us going?
Survive and thrive is my motto for 2023. Look, I think, in these times when we have, price action is either, down significantly or stable, and it's not attracting new money to the space yet. Those are the times when we need to build. And so hopefully companies have enough runway to survive and get through sort of the slower periods of volume so that, we can come out of it even stronger. And I think that certainly happened in 2018. And in 2017, everybody was moving into the space. In 2018, everybody sort of took a step back. But those who actually were being properly run, had proper treasuries, and were able to survive that period, certainly came out of that crypto winter even stronger with better services, better products, and better offerings. So I think that's the key here. Web3 is still relatively untapped. I think that's a huge, driver of additional adoption here. I would love to see more tokenization by the larger financial services firms. Like things like foreign exchange could easily be settled using blockchain rails. Things like equities that settle at T+2 could easily be settled same day using blockchain rails. And there are some people who are working on that. And so I'd love to see that be sort of the next phase, is, less about trading, the crypto assets that are from 50 to 100 and trying to hope you catch the next, 10, 50 bagger or whatever. And let's actually focus on the technology where we can actually improve and reduce the costs of these transactions in real day applications.
I think that's fantastic because that's where I'm really focused, because I really would like to see. I think we'll make some key inroads in 2023. I think a lot of institutions are waiting out through the end of the year to start revisiting where we'll go in 2023. But the private markets, especially in the funds. And so last question I'm slipping in. Are your clients actually requesting asset-backed digital securities, right? So traditional formats of trading instruments, because generally what you're talking about is volatility in the crypto market.
Right.
Have there been requests for buying securities on chain that are more traditional in format?
I think the private market in particular is where the demand is right now, because there really isn't a good solution there. I mean, so many cap tables are based off of Excel, and maybe some have moved to Carter or some of these other platforms, but there's no secondary liquidity in these markets, and so I think the private market has become so big, given the cost of funding over the last couple of years, that we'd love to see growth there, and I think our clients are definitely interested in that space. And I think as it relates to traditional securities, I think the problem is everybody feels like they can't move until their prime broker moves or their executing broker moves, and so it's sort of a chicken and an egg scenario where the real cost benefit in those scenarios is probably more to those large banks and the infrastructure providers. I think for a clearing broker to settle a equity on a T+2 basis, they need to hold capital, billions of dollars of capital, waiting for that transaction to settle. So I think that on the traditional security side, the main benefit is to most of the banks and clearing brokers who handle 80% of all equities transactions. I think with the private markets, certainly the cost of going public is prohibitively expensive. And so we'd love to see certainly the private market develop more on the security token side. I think there's plenty of client demand. I think there are a number of organizations trying to address it. And hopefully we'll see some movement in that space in the next 2 to 3 years.
Great. Thank you so much, Keith. I really appreciate it. This was a great conversation.
Absolutely. My pleasure. Thanks for having me.
Thank you. Thanks. Talk to
Okay.
you here.
All right.
Bye.
Take care.